Question 1. A taxpayer's filing status for the year is generally determined as of, is it A, the last day of the tax year? B, the date of the taxpayer's most recent pay period? C, the first day of the tax year? D, the date the return is filed? The correct answer is A. Filing status, single, married, head of household, etc., is generally determined by the taxpayer's marital and household situation on the last day of the tax year, December 31st for calendar year taxpayers. A special rule treats a taxpayer whose spouse died during the year as married for that year. Question 2. Which requirement must be met to file as head of household? Is it A, the taxpayer must have no dependents at all and must be legally married while paying less than half of the total cost of keeping up a home for a qualifying person? B, the taxpayer must be married and filing separately? C, the taxpayer must be unmarried, or considered unmarried, and pay more than half the cost of keeping up a home for a qualifying person? D, the taxpayer must earn below the standard deduction amount? The correct answer is C. Head of household requires the taxpayer to be unmarried or considered unmarried at year-end and to have paid more than half the cost of maintaining a home that was the principal residence of a qualifying person for more than half the year. It provides a larger standard deduction than single status. Question 3. Which of the following is generally excluded from a taxpayer's gross income? Is it A, cash gift received from a relative? B, interest earned on a bank savings account? C, wages reported on a Form W-2? D, net profit from a sole proprietorship? The correct answer is A. Gifts received are excluded from the recipient's gross income. Any tax consequence falls on the donor through gift tax rules. Wages, taxable interest, and business profit are all includable in gross income. Question 4. A credit differs from a deduction in that a credit, is it A, reduces gross income before AGI is computed? B, is always refundable? C, can only be claimed by businesses? D, reduces the tax owed dollar for dollar? The correct answer is D. A tax credit reduces the tax liability directly, dollar for dollar, making it more valuable per dollar than a deduction, which only reduces taxable income. Some credits are refundable and some are non-refundable, so not all credits are refundable. Question 5. Property sold for a gain after being held for more than 1 year generally receives, is it A, ordinary income treatment at the taxpayer's marginal rate? B, no tax because it was held over a year? C, long-term capital gain treatment at favorable rates? D, treatment as a non-deductible personal expense? The correct answer is C. A holding period of more than 1 year produces long-term capital gain, generally taxed at preferential rates lower than ordinary rates. A holding period of 1 year or less produces short-term gain taxed as ordinary income. Question 6. The gain or loss on the sale of a capital asset is computed as, is it A, amount realized minus adjusted basis? B, adjusted basis minus depreciation recapture? C, sales price minus original cost only, ignoring improvements? D, fair market value minus the standard deduction? The correct answer is A. Gain or loss equals the amount realized, what the seller receives, minus the adjusted basis. Adjusted basis starts with cost and is increased by improvements and decreased by items such as depreciation, so it is not simply original cost. Question 7. When a taxpayer has a net capital loss for the year, the tax law generally allows, is it A, limited amount of the net loss to offset ordinary income, with the excess carried forward? B, no deduction for capital losses under any circumstances? C, the loss to be carried back 3 years automatically? D, the entire net loss to offset ordinary income with no limit? The correct answer is A, capital losses first offset capital gains. A limited amount of any remaining net capital loss may offset ordinary income each year, and the unused excess carries forward to future years. The annual offset against ordinary income is capped. Question 8. Adjustments to income above the line deductions are important because they, is it A, reduce gross income to arrive at adjusted gross income, AGI? B, are only available to itemizers? C, directly reduce the tax owed dollar for dollar? D, apply only to corporations and other business entities that file their own separate entity-level income tax return each year? The correct answer is A. Above-the-line adjustments, such as the deductible part of self-employment tax and certain retirement contributions, reduce gross income to compute AGI. Because AGI drives many limits and phase-outs, these adjustments can be valuable and are available whether or not the taxpayer itemizes. Question 9. A general partnership reports its income to the IRS by, is it A, reporting all income on the managing partner's Schedule C, B, not filing any federal return? C, filing an information return, Form 1065, and issuing Schedule K-1s to partners? D, paying entity-level income tax on Form 1120? The correct answer is C. A partnership is a pass-through entity that files an information return, Form 1065, and issues each partner a Schedule K-1 reporting their share of income and deductions. The partners, not the partnership, pay the tax on that income. Question 10. Which entity's profits are subject to double taxation? Is it A, C corporation? B, an S corporation? C, a sole proprietorship? D, a general partnership? The correct answer is A. A C corporation pays tax at the entity level, and when after-tax profits are distributed as dividends, shareholders are taxed again, producing double taxation. Pass-through entities, S corporations, partnerships, sole proprietorships, are generally taxed only once, at the owner level. Question 11. Under the accrual method of accounting, income is generally recognized when, is it A, the tax return is filed and the related payment has actually been received in cash? B, it is earned, under the all events test? C, cash is actually received? D, the customer's check clears the bank? The correct answer is B. Under the accrual method, income is reported when earned, when all events fixing the right to receive it have occurred and the amount can be determined, and expenses when incurred. The cash method, by contrast, recognizes income when actually or constructively received. Question 12. The standard system used to depreciate most tangible business property placed in service today is it A, the cash method? B, the Modified Accelerated Cost Recovery System, MACRS? C, amortization over 15 years for all assets? D, straight line over the property's entire physical life? The correct answer is B. MACRS is the standard depreciation system for most tangible business property, assigning assets to recovery classes with prescribed methods and periods. Provisions such as Section 179 expensing and bonus depreciation can accelerate the write-off within limits. Question 13. A sole proprietor reports the net profit or loss from the business on, is it A, Form 941? B, Schedule C, filed with the owner's individual Form 1040? C, Form 1065 with Schedule K-1? D, a separate corporate return, Form 1120? The correct answer is B. A sole proprietorship is not a separate taxpayer. The owner reports business net profit or loss on Schedule C, which is filed with the individual Form 1040. The profit is also generally subject to self-employment tax. Question 14. An employer's obligations for employee wages include, is it A, withholding income and FICA taxes, paying the matching employer FICA share, and remitting FUTA? B, withholding only federal income tax and nothing else? C, paying the entire Social Security tax with no employee share? D, issuing a Schedule K-1 to each employee to report that workers' share of the business's annual wages and withheld payroll taxes? The correct answer is A, employers must withhold income tax and the employee share of Social Security and Medicare, FICA, pay the matching employer FICA share, and remit federal unemployment, FUTA, tax, reporting on returns such as Form 941 and Forms W-2. Employees receive a W-2, not a K-1. Question 15. To be deductible, a business expense generally must be, is it A, paid in cash only? B, capital in nature and depreciated over 39 years? C, personal to the owner? D, ordinary and necessary for the business? The correct answer is D. A deductible business expense must be ordinary, common and accepted in the trade, and necessary, helpful and appropriate. Personal expenses are not deductible, and capital expenditures must be recovered through depreciation rather than deducted immediately. Question 16. Treasury Circular 230 governs, is it A, the interest rate on tax refunds? B, the rules of practice before the IRS by enrolled agents and other practitioners? C, the depreciation of business assets? D, the calculation of the standard deduction? The correct answer is B. Circular 230 sets the ethical and professional standards for practitioners, including enrolled agents, attorneys, and CPAs, who practice before the IRS. It covers due diligence, fees, conflicts of interest, and grounds for sanctions. Question 17. Enrolled agents are distinguished by having, is it A, unlimited rights to represent any taxpayer on any tax matter before any IRS office? B, authority to practice only before the United States Tax Court after passing that court's separate written admission examination? C, the ability to represent only individual, not business, taxpayers? D, no authority to receive confidential taxpayer information? The correct answer is A. Enrolled agents, like attorneys and CPAs, hold unlimited representation rights before the IRS, meaning they may represent any taxpayer on any type of tax matter before any IRS office. This is broader than the limited rights of some other preparers. Question 18. Which form authorizes a practitioner to represent a taxpayer and act on the taxpayer's behalf before the IRS? Is it A, Form 2848, Power of Attorney and Declaration of Representative? B, Form 8821, Tax Information Authorization? C, Form 941, Employer's Quarterly Federal Tax Return? D, Form W-9, Request for Taxpayer Identification Number? The correct answer is A. Form 2848 grants a power of attorney, authorizing the practitioner to represent the taxpayer and act on their behalf. Form 8821 only allows a person to receive and inspect confidential tax information. It does not authorize representation. Question 19. A taxpayer who receives a statutory notice of deficiency and disagrees with it may generally challenge the tax without first paying it by petitioning. Is it A, the U.S. Court of Federal Claims? B, the U.S. District Court? C, the U.S. Tax Court? D, the Supreme Court directly? The correct answer is C. The U.S. Tax Court is the only forum where a taxpayer can litigate a deficiency without first paying the disputed tax, by filing a petition within the period stated in the statutory notice of deficiency. The District Court and Court of Federal Claims generally require paying the tax and suing for a refund. Question 20. Under Circular 230, when a practitioner discovers an error or omission on a client's return, the practitioner must, is it A, report the client directly to the IRS and withdraw from the engagement before advising the client of the error? B, promptly advise the client of the error and its consequences? C, ignore it unless the IRS asks? D, immediately amend the return without telling the client? The correct answer is B. Circular 230 requires a practitioner who learns of an error or omission to promptly advise the client of it and of the consequences under the law. The practitioner cannot correct the return without the client's consent, but must inform the client. Question 21. A paid tax return preparer is required to, is it a, guarantee the client a refund? B. Represent the client for free in any audit. C. Retain the taxpayer's original documents permanently. D. Sign the return and provide a valid preparer tax identification number, PTIN. The correct answer is D. Paid preparers must sign returns they prepare and include a valid PTIN, and they must meet due diligence and record-keeping duties. They may not guarantee refunds, and they return original documents to the client. Question 22. The IRS Independent Office of Appeals exists to, is it A. Collect unpaid taxes through liens and levies? B. Set the annual tax rates and inflation-adjusted brackets that the examination function then applies to each return? C. Prepare returns for taxpayers who cannot afford a preparer? D. Provide an impartial review of disputes between taxpayers and the IRS? The correct answer is D. The Independent Office of Appeals offers taxpayers an impartial, independent review of proposed adjustments, aiming to resolve disputes without litigation. Collection functions, not appeals, handle liens and levies, and Congress sets tax rates. Question 23. A married couple wants the lowest combined tax and full access to credits. Which filing status is generally most advantageous and combines both spouses' income on one return? Is it A. Head of household? B. Qualifying surviving spouse? C. Married filing jointly? D. Married filing separately? The correct answer is C. Married filing jointly combines both spouses' income and deductions on one return and generally yields the lowest tax and the broadest access to credits, e.g., EITC, education credits, that are reduced or denied to MFS filers. See IRC Section 6013 and PUB 17, Filing Status. Question 24. A taxpayer's spouse died in the current year and the taxpayer did not remarry. For the year of death, the surviving spouse may generally file as, is it A. Qualifying surviving spouse? B. Single only? C. Head of household only? D. Married filing jointly? The correct answer is D. For the year a spouse dies, the surviving spouse is still considered married and may file a joint return, MFJ, with the deceased spouse if not remarried by year-end. Qualifying surviving spouse status applies to the 2 years after the year of death, not the year of death. See IRC Section 6013, A3, and PUB 17. Question 25. To file as a qualifying surviving spouse in a year after the spouse's death, the taxpayer must, among other requirements, is it A. Be over age 65? B. Have remarried during the year? C. Have a dependent child and pay over half the cost of keeping up the home? D. Have no income of their own? The correct answer is C. Qualifying surviving spouse status is available for up to 2 years after the year of death if the taxpayer has not remarried, has a dependent child living in the home, and pays more than half the cost of maintaining that home. It provides the joint standard deduction and rates. See IRC Section 2, A, and PUB 17. Question 26. A married taxpayer lived apart from their spouse for the last 6 months of the year and paid more than half the cost of a home that was the main home of their dependent child. This taxpayer may be treated as, is it A. Ineligible for any status except married filing separately? B. A qualifying surviving spouse? C. Considered unmarried and eligible for head of household? D. Single for all federal purposes including the marriage itself? The correct answer is C. A married person who lived apart from their spouse for the last 6 months of the year and maintained a home for a dependent child is considered unmarried and may file as head of household. This is the abandoned spouse rule. See IRC Section 7703(b) and PUB 17. Question 27. Which is a common disadvantage of the married filing separately, MFS, status? Is it A. Both spouses must use the same employer and file a single combined return reporting all of their wages together? B. The taxpayers cannot claim any standard deduction. C. Many credits, such as EITC and most education credits, are reduced or disallowed. D. It always produces a higher standard deduction than joint filing. The correct answer is C. MFS filers lose or have limited access to numerous benefits, including the Earned Income Credit, most education credits, and the Child and Dependent Care Credit, and if one spouse itemizes, the other generally must itemize too. See PUB 17, Filing Status. Question 28. A U.S. citizen is married at year-end to a non-resident alien and makes no special election. Absent that election, the U.S. citizen generally may not file as, is it A. Married filing jointly? B. Head of household, if otherwise qualified through another relative. C. Married filing separately. D. Single, because they are married? The correct answer is A. A U.S. citizen married to a non-resident alien cannot file jointly unless both elect under IRC Section 6013(g) to treat the non-resident spouse as a U.S. resident for tax purposes. Without that election, MFS applies, or HOH if the citizen qualifies through another dependent. See PUB 519 and PUB 17. Question 29. A couple obtains a final divorce decree on December 30th. Their federal filing status for that entire tax year is determined as, is it A. Unmarried, so single or head of household if qualified. B. Married, because they were married most of the year. C. Married filing jointly by default. D. Whatever status they used the prior year? The correct answer is A. Marital status is determined on the last day of the tax year. A taxpayer divorced under a final decree by December 31st is treated as unmarried for the whole year and files single or, if qualified, head of household. See IRC Section 7703(a) and PUB 17. Question 30. For head of household, the qualifying person generally must have lived with the taxpayer for more than half the year, except that a dependent parent, is it A, can never be a qualifying person for head of household. B, need not live with the taxpayer if the taxpayer pays more than half the cost of the parent's home. C, only qualifies as a dependent parent if that parent files a joint return with a spouse and lived in the taxpayer's home for the full year. D, must always live with the taxpayer for the full year? The correct answer is B. A dependent parent is an exception to the live with requirement. The taxpayer can claim head of household if they pay more than half the cost of keeping up a home, including a nursing home, that is the parent's main home, even if the parent does not live with the taxpayer. See PUB 17, Head of Household. Question 31. Which is one of the tests a person must meet to be the taxpayer's qualifying child? Is it A, the child must not have provided more than half of their own support? B, the child must be under age 13 in all cases? C, the child must have gross income below a set dollar threshold? D, the child must be the taxpayer's biological offspring only? The correct answer is A. A qualifying child must meet relationship, age, residency, support, and joint return tests. The support test for a qualifying child asks whether the child provided more than half of their own support. If so, they are not a qualifying child. The gross income test applies to qualifying relatives, not qualifying children. See IRC Section 152(c) and PUB 501. Question 32. Under the age test for a qualifying child, the child generally must be, is it A, under age 21 with no exceptions? B, under age 19, or under age 24 if a full-time student and younger than the taxpayer? C, under age 17 to be a dependent at all? D, any age at all, provided the child is unmarried and did not file a joint return with a spouse for the year? The correct answer is B. A qualifying child must be under age 19 at year-end, or under age 24 if a full-time student for at least 5 months, and younger than the taxpayer, or the taxpayer's spouse if MFJ. A permanently and totally disabled child meets the age test at any age. See IRC Section 152(c)(3) and PUB 501. Question 33. For a person to be claimed as a qualifying relative, the person's gross income for the year must be, is it a, less than the exemption-based gross income threshold set for the year? B, above the annual exclusion for gifts? C, equal to the taxpayer's income? D, more than the standard deduction? The correct answer is A. A qualifying relative must have gross income below an inflation-indexed threshold tied to the exemption amount, and the taxpayer must provide more than half of the person's support. Because the exact figure is indexed annually, the concept, a set low threshold, is what governs. See IRC Section 152(d) and PUB 501. Question 34. The support test for a qualifying relative requires that, is it A, the taxpayer provided at least 10% of the person's total support for the entire calendar year? B, the person lived with the taxpayer all year in every case? C, the taxpayer provided more than half of the person's total support? D, the person provided more than half of their own support? The correct answer is C. For a qualifying relative, the taxpayer must provide more than half of that person's total support for the year. This differs from a qualifying child, where the question is whether the child provided over half of the child's own support. See IRC Section 152(d)(1) and C and PUB 501. Question 35. Under a multiple support agreement, a taxpayer may claim a dependent even though the taxpayer paid 40% of support if, is it A, the dependent has no other relatives? B, the taxpayer paid the most of any single person? C, the taxpayer paid more than 10%, no one paid over half, and the others who could claim the dependent signed Form 2120? D, the taxpayer is the oldest contributor? The correct answer is C. A multiple support agreement lets one of several contributors, who together paid over half, claim the dependent if that person paid more than 10% and each other eligible contributor agrees in writing via Form 2120 not to claim the dependent. See IRC Section 152(d)(3) and PUB 501. Question 36. When a child is the qualifying child of both divorced parents, the tiebreaker rules generally award the dependency to, is it A, the parent with the higher income automatically? B, the custodial parent, the one with whom the child lived the greater number of nights? C, both parents equally, so each may claim exactly one half of the dependency benefit for the shared child? D, whichever parent files first? The correct answer is B. When both parents could claim the same qualifying child and no agreement releases the claim, the tiebreaker awards it to the custodial parent, generally the one with whom the child lived the greater number of nights. If nights are equal, the parent with the higher AGI. See IRC Section 152(c)(4) and PUB 501. Question 37. A custodial parent wishes to let the non-custodial parent claim the child as a dependent. The proper way to do this is it A, both parents claim the child and the IRS sorts it out? B, a verbal agreement is sufficient? C, the custodial parent signs Form 8332 releasing the claim, which the non-custodial parent attaches to their return? D, the non-custodial parent simply claims the child? The correct answer is C. The custodial parent releases the dependency claim and the child tax credit by signing Form 8332, Release/Revocation of Release of Claim to Exemption for Child by Custodial Parent, which the non-custodial parent attaches to their return. See IRC Section 152(e) and PUB 501. Question 38. A person filing a joint return with their spouse generally cannot be claimed as a dependent by another taxpayer. An exception exists when, is it A, the dependent is over age 18 at year-end and was enrolled as a full-time student for at least 5 months during the tax year? B, the couple lives in a community property state? C, The joint return is filed only to claim a refund of withholding and neither spouse would owe tax filing separately. D. The dependent earned wages during the year? The correct answer is C. The joint return test bars claiming a married person as a dependent, unless the couple files jointly only to claim a refund of withheld or estimated tax and neither spouse would have a tax liability on separate returns. See PUB 501, Joint Return Test. Question 39. The citizen or resident test for a dependent generally requires that the dependent be, is it a citizen of any country as long as related? B. Present in the U.S. every day of the year. C. A U.S. citizen, U.S. national, or resident of the U.S., Canada, or Mexico. D. A resident of the taxpayer's state? The correct answer is C. To be claimed as a dependent, a person generally must be a U.S. citizen, U.S. national, U.S. resident alien, or a resident of Canada or Mexico for some part of the year. See IRC Section 152(b)(3) and PUB 501. Question 40. A taxpayer who can be claimed as a dependent on someone else's return, is it a, may still claim their own dependents freely? B. Cannot claim any dependents of their own on their return. C. Owes no federal income tax regardless of the amount of income earned during the year. D. Automatically files head of household? The correct answer is B. Under the dependent taxpayer test, a person who is, or can be, claimed as a dependent by another taxpayer may not claim anyone else as their own dependent. See PUB 501, Dependent Taxpayer Test.